The views and opinions of this program are those of the host, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Today's episode of Market Talk is brought to you by Growmark FS. Keeping up with the latest in ag is a challenge, to say the least, but there are experts nearby ready to help. You'll find them at your local FS. You can trust them to bring you customized agronomic, grain, and energy solutions born of the latest thinking. That's because FS specialists receive continuous training that keeps them current on the latest trends, practices, and technologies. So you'll get local expertise that's both exceptional and up to date. Visit fssystem.com to learn how FS is bringing you what's next. Well, as we wrapped up the month of May on Wednesday in this holiday shortened trading week, it was looking like another rough day of the grain and oilseeds when we started things off. But lo and behold, we ended the day with a fairly mixed commodity board, even some green numbers creeping in on the screen. So what do we make of this as we wrapped up the day on Wednesday? Well, let's talk about it. We bring in Mike Zuzolo of Global Commodity Analytics. He's our guest analyst here today on the show. Mike, it is great to catch up with you again, and I hope things are going well in your neck of the woods.
Yes, we were blessed with some rains the past 24 hours, Jesse, and really feel blessed and lucky because very isolated on the eastern side of Kansas, western side of Missouri, probably only about 60, 70 miles in on each side of those states. Otherwise, been pretty hit and miss, and there's a lot of clients I'm talking to right now that are getting very, very dry in the soft red wheat country, getting very, very dry in corn country, from essentially Albany, Illinois, all the way up to Lafayette, Indiana. Clients I spoke with today are talking about how they've only had about a 3/4 of an inch rainfall for the whole month of May, and that their perfect wheat is now getting hit and their corn stands are going down, and it could be a really tough week next week if we warm up and we don't see any rain showers.
Well, that's a great point you make there, Mike. And I know we're going to weave that into our discussion here today with this weather outlook as well and the impact we could see with that dryness. But I just want to start. I mentioned how we rallied off the lows throughout the session on Wednesday. It is the final day of May. So did we see a bit of maybe short covering positioning to wrap up the month? Is that some of the reasoning behind this rally in the grain trade? What's your thoughts with how things settled up on Wednesday, Mike?
Yeah, this is a tough thing right now because the end of the month brings in an added element of uncertainty about whether this is really the low in the marketplace. After seeing the overnight Globex trading lows, if we would have closed there, the month of May would have been down about 8% to 9% in the corn, down about 12% in the soybeans, down about 7.5% in soft red wheat, down about 5.5% in hard red, and 7.5% in soft red, if I remember right. And those would have been, I think, levels that I could have been more justified in saying this is too cheap. We need to bounce now that we come into June. What's holding me back is the fact that we're seeing imports of both wheat and soybeans coming into the United States. And it makes me very nervous that the trade is going to start to assume that rallies are still meant to be sold, because if the price at the mercantile exchange gets too high, we're just going to bring more of those commodities in, or we'll have more cancellations of corn by China. So what we need before that, Jesse, I think, is some technical support to come in and kind of validate and support the fund-driven mindset that you and I often talk about. And that goes back to the dollar. It goes back to the commodity indexes. It goes back to the European wheat. One thing that I've made very clear to you and many that I speak with is I thought May could be a counter-seasonal rally month if the dollar and the wheat would lead us, because April was a counter-seasonal wheat month. We didn't get that because the dollar and the wheat. So I'm still stuck in that bog, in that swamp of the dollar and the wheat. The second thing I really pushed hard, I think, in the last month or two has been the soybeans are the weakest suit of cards out there. That indeed has been proven as correct. And I think even there, the soybeans are hitting price points, given the weather that we're going through. They should start to join up and willingly want to rally once the corn and the wheat lead them out of the hole. So I kind of feel like I'm at the beginning of May all over again after a big break to the downside in April. I feel like it's almost Groundhog Day all over again.
Yeah, well, Mike, we have a couple different charts that we want to look at on the video feed to tie in with this discussion as well. And I think for me, one of the biggest things that I'm wondering about, and I think a lot of folks are wondering about, is just some of this falling demand for commodities, maybe falling demand for U.S. commodities, and a lot of that tied to China. I know we have more economic concerns. There's more COVID concerns in China as well. So let's walk through this first chart, looking at China's PMI, and just update us on the China situation when it comes to commodities and their economy, et cetera. What are you seeing here, Mike?
Yeah, the big news about the soybeans coming into the United States was, I think, one of the two biggest features to why we got hit so hard in the Globex trade Thursday morning. And I think Wednesday morning. And I think this goes back to this PMI chart. And what I highlighted in that orange box are the old highs coming out of COVID for these PMIs, both manufacturing and services. And you notice with the numbers that came out on Wednesday morning, late Tuesday night, we see that both the manufacturing and services have fallen from their peak made a month and a half ago, and are now back below where they were in their peaks right after the COVID scare. The initial COVID scare was built in. And this goes back to, I think we've been trading negative Chinese mindset for a better part of 3 months, Jesse. We thought that the market would find a lot of support coming out of that zero COVID policy shift, that we started to price it in with weaker dollar, stronger emerging market currencies, stronger emerging market equities markets. And we talked about this. It just didn't look like it was going to hold because the data was not holding back in February, early March time period. So this data is now kind of catching up. And the trade, I think, has got very well and adequately priced in a very slow recovery in China. And so I want to say the worst is over when it comes to the commodities and the emerging market currencies, and the strength in the dollar driven by that, and also driven by the debt ceiling issue. That helps explain, I think, a large percentage of how we could be getting hit so hard in prices when the weather does not look good in Brazil or here in the States.
I'm going to flip over to the Bloomberg Commodity Index chart. We've been looking at this, you and I have, for the last month or so here. So get us up to speed on this chart. What are you seeing? How's this tie in with things?
Yeah, this is where it gets a little bit more technical, gets a little bit more fund driven based upon the research and analysis I do on funds and how they operate, or many of them like to operate. Technically speaking, we have that wedge that, as you say, you and I have tracked for several months now. We broke below that wedge support. We've now added to the negativity. And essentially what have been talking about for a long, long time is, if we go below 45 in that wedge, that major moving average in purple, which is currently around 46, we take that out, then we have opened the downside up. That could take us down to 40. And that's the major support line. You can see where that was the major support until 2016, when we went well below that. I'm not seeing that type of scenario again. I think inflation is too high, and commodity demand, as you said a minute ago, it's very strong. It's just, it's displaced that we're not getting the business. So I'm inclined to think we're going to hit 40. We'll find some support there. And that would be about a 5 percentage point break from the 42 area. And that kind of matches up real nicely with the European wheat, which again is, I think, the key, especially given the imports that we've seen coming out of Eastern Europe.
Well, let's talk about those Eastern Europe wheat exports, especially here into the U.S. And I know we've heard the news about wheat from Poland coming into the U.S. I had a listener question as well, asking, how is Poland producing wheat cheaper than the U.S.? And you and I talked about this a little bit off air. It's not really a matter of producing it cheaper. It's just the market dynamics are different. U.S. wheat's more expensive. So walk us through this chart and some of those ideas that you're seeing here as we look over at EU wheat.
Yeah, you bring up a huge point, and I'll just further that mindset. it is that U.S. wheat is too expensive because the European wheat has not stopped falling. And that is because the Polish wheat has been pushed into the Netherlands and has been pushed into Western Europe. And that's because the Ukrainian wheat has been pushed into Poland. And so they've changed the logistics and transportation. They can't get it out of the Black Sea fast enough in Ukraine. And so they're moving it west now. And Poland's taken a lot. I've got a very good client in Sweden, in the Netherlands and Sweden area that's talking about how even they are feeling the impact of cheaper Polish wheat coming into their area, and it's because of Ukrainian wheat displacing it, Ukrainian corn displacing it as well. So now thinking about that 5% move to the downside, to the support and the commodity index we just looked at, where is 5% down in the EU milling wheat chart here we're looking at, and it's right around $6. And so if we would fall from $6.32 to $6, I think that would be a major support level. That takes you back to levels well before the pandemic, well before the Russia-Ukraine war. And with the grain deal looking like it's falling apart each and every day, and more violence and more war happening in the Black Sea and the ports like Odessa. I think the last Navy ship from Ukraine just got sunk overnight, and it was near the port of Odessa by some reports. This EU wheat, I think, is within 30 cents of a major support level, or around 5%. So that's where I go hunting for the idea of maybe lifting soybean hedges and maybe adding to my feed hedges on the corn side of the equation.
Well, we are having a conversation today with Mike Zuzolo of Global Commodity Analytics. And Mike, to button up our grain talk here a little bit, we touched on the weather earlier, and I know that the latest forecast model runs still looking rather hot and dry as we get into June, but then a lot of these model runs showing rain coming into a wide area of the Corn Belt as we get into the second half of June. I just wonder your thoughts on this weather outlook. I know that could be a bit of a canary in the coal mine, so to speak, here, if we don't get the rain that is in the forecast.
Yeah, this is where it goes back to, looking at both U.S. weather and Brazilian corn weather, because the Brazilian corn crop's gotten bigger this week as well by some private trade guesses. And they've really, I think, kind of shoved away the idea that crop could still be clipped pretty dramatically in terms of ears and tip back because of the lateness of the crop. And so I'm in a situation now, Jesse, where these models, and I look at the models all day long and all night long, just like everybody else does. And then I also use meteorological information that I buy as well. And I've had some training from some people that were meteorologists. And so what I would say to you right now is the meteorologist you trust is the one you want to stick with. After 5 days, these models are essentially zero usefulness and become very useless. Even some of the most sophisticated models that I look at, the predictability is down to 10 or 15% after 7 days. And so we don't know what is in store past next week. And next week is even a stretch given this pattern currently. And so I would say this, that much like Brazil, we could be in a very tough spot and have lost the very top of our corn and bean crop for this year in the next 2 weeks if we don't get rain, and especially if we warm up, because today's genetics use this time period for yield. It's not about July 4th like it used to be. It's about right now. And I think here again, the trade probably isn't even thinking of that right now. We'll see if the crop conditions next week start to show that up more, both in wheat and in corn.
Good things to consider here for sure. Mike, let's switch over to livestock, and I want to touch on cattle first. One more chart on our video feed, the December live cattle continuation chart. Walk us through what you're seeing here and just get us up to speed with your thoughts in this cattle trade as we wrap up the month.
Yeah, I've been waiting very hard, and it's been a hard fought to hold back on hedging, but I've been glad I have. But now that I'm in June, I'm on, pretty much let's get it done in the first 10 days of June when it comes to the cattle market. I've gotten the hog rally that I've wanted, and we've seen the feeders move with the corn. And if you look at this chart, this is the December futures only going all the way back to 2014. We are now about $8 to $9 above 2014 when it comes to December futures, and that high. And we're also about $7 above my overvalue level. And so anywhere from $7 to $9 above some key areas, and that's usually you get towards a $10 premium in some of these I guess areas that are useful and maybe are good places to put a marker down. I think it's time to get some deferred hedges in place. I don't need to do anything in the nearby because we're still not knowing what the cash is, and the futures doesn't have as much premium in it as the cash market does, especially if we'd go back to 175, 176, which I think we can do with the hog rally that we've seen. But those deferred markets, they're getting there to the point where I think these are areas to get some hedges in place. And by waiting until June, I don't think you have to take unlimited risk in futures. You may be able to start fishing around for some bought puts and get a nice floor in place.
Well, I know sticky inflation, of course, is an issue throughout the entire commodity sector, but seems to correlate itself into livestock a little bit more. It seems like you think about that, cheaper feed prices as well, kind of the balancing act there. I know those are some other things to consider here throughout this cattle trade and in hogs too.
Yeah, and I think you really touched on something important there, Jesse, is if you can knock down both a floor on the cattle side and the feeder side, and then your feed side as well, you really do have unlimited potential on your cash market then as far as what your profitability could be. And I do think that we have to keep reminding producers out there, and I think the grain market gets this because of the dollar rally, but I think the livestock producers really need to remember there is probably a recession, a good chance of a recession coming here at the end of the year. And so we want to use the strong summer grilling season and the low gas prices currently to, I think, get our operations protected and to the downside, especially as we get into this 175, 180 level in the December fat cattle.
And you mentioned you got the hog rally you wanted. I'm with you. I'm cheering. I want to see one more day, though, of another aggressive move to the upside, I think, in this hog market here, Mike. But it's been a good couple of days so far.
Yeah, the cutout's the big issue now. We've been able to match up the cash index with the futures, and now we've got the cutout starting to move, but we need to get that cutout to really start rolling. And I think it can. I think pork's going to win this battle at the summer grill. I think that's what we saw after this past weekend, that the pork side of the equation. And Costco made some comments after the weekend that they saw consumers move away from the beef and move towards poultry and pork. And I see that continuing given the prices of tenderloins and some of these higher cuts that are really nice cuts in terms of value.
Mike, we've covered a lot. I always appreciate your insight into this market trade. Any final thoughts for us before we wrap it up today?
No, just consider getting a trial. I mean, this is where the market's moving. I mean, we had a 30-cent range within a number of hours today. It's not going to change. It's going to get more violent and more volatile. And, you don't want to put your head down and not look at it. I think you just need some help in keeping track of things. And hopefully we can do that. So please check us out at the Global Com Research website.
Again, that website, globalcom with 2Ms research.com is where you can find more information. With that, Mike Zuzolo, Global Commodity Analytics. Always great to talk with you, sir. Have a great week. We'll talk to you next week.
You too, Jesse. Nice to have you back, and congratulations again on your marital bliss.
Thank you very, very much, and I am very happy to be back. That is going to do it for today's program. Find us online, markettalkag.com. I'm Jesse Allen. Have a great afternoon.